Hi everyone, and welcome to this webinar about energy transition plan of Equinor and the profitability in a 1.5-degree world. My name is Ragnhild Waagaard. I work as an oil and gas lead in WWF, and I will be leading this meeting together with my colleague, Senior Advisor Guro Lystad, who will make the findings that we have found about Equinor. We work in WWF Norway, and we have been using the Rystad database to find numbers about Equinor's operations. Before we start, I would just like to say that we will record the session and we will send you the session afterwards on your email. And if you have any questions, please send them in the chat. So we will try to answer along while we go, or we will try to reply to you at the end of the meeting or in email afterwards. So I think we start there, and Guro, if you could change the slide, please. So I think just before I hand over to Guro, I would just like to say a few words about why we are concerned about Equinor. And it's not only because they are a big an important voice in the Norwegian debate about oil and gas and energy transition, but also because they actually is a very huge oil and gas company, being the 18th biggest oil and gas company in the world. And because the Norwegian state is a major investor and owns 67% of the shares, and you also have Folketrygdfondet, who has a considerable amount of shares, it is in reality up to us Norwegians to know what is going on with Equinor. And the way Equinor is seen outside Norway is also a reputation risk for Norway and Norwegians. And what we have seen is that Equinor is responsible for oil and gas operations in vulnerable areas. We have contacts with colleagues and friends all over the world, from Australia to Canada to Argentina and more, who are worried about operations that Equinor is planning or having in their area. So we think it's important to raise their voice in Norway. And at last, I would also say that we see that Equinor has shown that they are willing to listen and to change. Since 2009, together with Greenpeace, WWF has been present at Equinor's assembly, General Assembly, and giving shareholder resolutions. And we have seen that they have been followed up, some of them at least. And this year we have a new resolution together with Greenpeace. It's about cutting their emissions, including Scope 3, with 50% within 2030, and to reduce all their emissions by 2050 in order to be aligned with the 1.5-degree target. And I think that's all from me, and I will hand over to Guro. Please go ahead. You have to unmute, Guro.
Yes, thank you, Ragnhild. As Ragnhild said, my name is Guro. I work with climate and energy at WWF. I will go through some of the background, why we think this is important, and have a closer look at the energy transition plan that Equinor has presented. And then I'll also show you some calculations that we have used using numbers from the Rystad database, but the calculations are made by WWF, where we have stress tested the portfolio of Equinor in a 1.5-degree price scenario. So the reason why we're so concerned is, while most countries in the world have actually pledged to cut their demand for fossil fuels and their emissions in line with the Paris Agreement, we haven't seen the same commitment to the supply side of oil and gas and coal production. And actually, if you look at the production gap report, it states that governments are planning to increase their production of fossil fuels, and it would be produced 259% more oil and gas in 2040 than what there is room for in a 1.5-degree scenario. And many agencies have stated, for instance, the International Energy Agency stated that there is no room for new oil and gas investments after 2022 if you want to reach the 1.5-degree target. And one of the reasons why we are so concerned about investments right now is that it has a great impact in many years to come. This graph shows the typical horizon for an oil and gas field. Usually it would take maybe 10 to 15 years from a discovery is made to actually production starts. And then production could then last for 10 to 30 years, depending on the size of the oil field. And this means that if you're making an investment in a new oil and gas field right now, that could result in production going beyond 2050 when the world has to reach net zero. Another problem with oil and gas investments is that most of the investment is coming up front before production starts, while during production, the operational costs are quite small. So as an oil and gas investor, you would have an incentive to continue production, even though as long as your operational costs are not higher than the oil price. So for instance, if an oil and gas investor like Equinor decided to develop a new oil and gas field because they had very high hopes for the future oil price, and then the price suddenly ended up dropping maybe in 2030 or 2040, Equinor might have wished that they could go back in time and not make that investment. But when they're actually standing there in 2030, they would just continue production in order to recover some of the earnings or some of the investment that has been made. And this is quite critical because it shows that you have a large risk of locking in emissions based on investments decisions now. And this is why we want Equinor to actually transition into a renewables company, showcasing that they're not willing to do any more new investments in oil and gas, because we know that new investments in oil and gas assets wouldn't be in line with a 1.5-degree target. So I'll just showcase Equinor launched new climate commitments last summer, and then in March they presented an energy transition plan that they are asking their shareholders to vote on at the AGM in May. This plan, it involves a 50% of reduction in operated emissions, which means emissions that come from actual production. It's important to notice that if you look at the life cycle of an oil and gas barrel, it's actually only 5% of the emissions that happens in the production phase, while 95% of the emissions happen when you burn the fossil fuel later on. So while it's admirable that Equinor is planning to reduce these operations, it doesn't mean that much when it comes to the overall supply of fossil fuels emissions that they're putting onto the market and the associated emissions with that. So Equinor also has another target that says something about the net carbon intensity. And this, I'll come back to it, but it means basically the emissions involved with oil and gas productions divided on total energy production. And Equinor is planning to reduce this indicator with 20% by 2030, 40% by 2035, and then reach net zero by 2050. And in this case, they have also included the emissions from use, which we call scope 3. And then the final target is that Equinor is planning to increase their investments in renewables and low carbon solutions and have this be 50% of their investments in 2030, which is good. But then again, if you think about it, it means that 50% of the investments would go into fossil fuels in 2030 as well, which is not that great. So a bit more about the net carbon intensity. This is a graph coming from Equinor where they explain this indicator. So these are all the emissions. The scope 1 and 2 is from production and extraction of fossil fuels. Scope 3 is the emissions coming from combustion of fossil fuels. Then you have, you can subtract carbon sinks, which is natural carbon storage solutions, and technical carbon storage solutions, which we call CCS. And then they take these emissions and divide it on the overall production of energy, which includes both oil and gas, but also electricity, hydrogen, and biofuels. And then you end up with this target, which is called net carbon intensity. And there are several ways to actually reduce this indicator. One is to reduce the actual emissions associated with oil and gas production, which would mean scope 1 and 2 and 3. But then Equinor could also reach this target just by increasing the overall energy production from other energy sources without downscaling on the oil and gas production. And then the third option is that they could also purchase offsets from natural carbon solutions or other carbon trading schemes in order to meet this target. And we are quite concerned about oil companies purchasing areas associated with carbon solutions in order to justify continued oil and gas production, because these areas are needed to reach the 1.5-degree target and not to offset other emissions. And Equinor says in the point of the energy transition plan was to showcase how Equinor was planning to reach this target. But actually the plan doesn't say anything about how the involvement within each of these categories will happen. So we don't know anything more than the actual targets and some goals for instance, CCS or hydrogen, but we don't know how Equinor is actually planning to reach the target and which categories they're planning to increase and which they are planning to decrease. And Equinor also states that they're actually planning to increase their oil and gas production until 2026. And when we added the numbers in the Rystad Energy database, we found that Equinor would end up increasing production until 2030. In this graph, we've added all the assets that Equinor is holding. You see the orange ones are from producing existing fields. The green one is from fields that are currently under development. Pink ones are where there is a discovery that Equinor is owning or partly owning, but where an investment decision hasn't been made. So this would include maybe the, for instance, the Wisting field in Norway or Bay du Nord in Canada. And then you also have undiscovered assets, which means where Equinor holds licenses or have access to areas that they can use to discover oil and gas resources. For instance, right now they are doing seismic testing offshore the coast of Argentina in order to discover more oil and gas assets. And the problem here is that actually the emissions would increase with 22% between 2022 and 2030 if all of this was produced, which is why we don't think the net carbon intensity goal of Equinor is sufficient, because it doesn't mean actually downscaling fossil fuel production, but involves rather an increase in fossil fuel production. And we are concerned because this is not, we don't think this showcases a company that is in line with the 1.5-degree target, or actually showcase that they are planning to transition into a renewable company in time. And this is the reason why we've added our proposal, where we want to reduce the absolute emissions, which would mean no new development of discoveries, no new oil and gas exploration, and cutting emissions with 50% from all of these assets, including scope 3 by 2030, and then reach net zero in 2050. I'll go a bit into Equinor's portfolio. So this is the data from Rystad Energy, and it's showcased that Equinor has the most assets in Norway. Currently, Angola and the United States are on second and third place. Then when it comes to discoveries, these are all the discoveries. It doesn't mean that Equinor will develop them all, but they are holding discoveries in several countries, many of them in Norway. And then there are the licenses and awarded acreage in different countries. It doesn't necessarily mean that Equinor will continue to explore for oil and gas in all of these countries, but it might. So this is the price assumptions that we've done when we've calculated or when we've done the stress test of the portfolio. So we've used this orange line is the base case price scenario that Rystad Energy uses as their best guess for the future oil price. As you can see, it ends up at $50 per barrel from 2026 and onwards. Then we've added the IEA net zero emission scenario, which ends up at 24 USD per barrel in 2050. And then we've also added another 1.5-degree scenario, which Rystad Energy has made based on the assumptions of fossil fuel consumption in the IEA net zero emission scenario, but Rystad has made their own oil price modeling tool to end up with this price scenario instead of the one IEA ends up with. And in this case, the oil price drops to $20 per barrel from 2025 and then to $10 per barrel from 2046. And just to comparison, Equinor states themselves that they expect an oil price above 65 USD per barrel until 2040 and then at 60 USD per barrel in the 2050, which means that Equinor's expectation of an $2 future oil price is much higher even than the base case scenario that Rystad Energy uses. So Equinor has added a portfolio stress test in their sustainability report, where they have used the different scenarios from the IEA, including the net zero emission scenario. And according to Equinor, the net zero emission scenario would end up decreasing NPV, which is a term that you use for the return on your investment. It means net present value. It would reduce the value of the portfolio with 34% compared to their base case scenario. So I tried replicating this calculation with the IEA scenario and using the Rystad data. And I actually end up with a decrease of 67% compared to Equinor's 34%. And I've seen also other investors questioning whether these calculations are correct, because they also end up with a much lower number than what Equinor reports. So it's not easy for us to say actually what lies behind Equinor's number, but I think it's important that they actually address this issue with their shareholders and explain a bit more what lies behind their estimates here. Because from what we can see, it seems like the climate risk is way bigger than what is reported in their sustainability report. So further on, what I've done is that I've calculated the net present value of the portfolio, dividing the portfolio on producing fields and fields under development, and then discoveries, and then undiscovered resources. And I've used the 3 different price scenarios to calculate the net present value for each category. So if you look only at the producing fields and fields under development, in all of the cases, you end up with a positive return on the investment. And this is mostly because it has already been paid back, because there are producing fields that have benefited from the current high oil price. So there aren't that much risk associated with the producing fields. When it comes to the discoveries, on the other hand, the value is positive in the base case scenario, but it turns negative in the IEA scenario and the Rystad scenario. And then when it comes to undiscovered assets, actually the net present value is negative for all 3 price scenarios. So if I were an investor at Equinor, I would want the company maybe to continue producing from existing assets, which seems like a safe investment, but then not to continue exploration in discoveries and undiscovered resources, which is a much more uncertain project, and rather either use that money to transform into a renewable company or paying it back as dividends to shareholders. So I made some more just to showcase the split. These are the number of assets from the producing assets and assets under development. 160 of those assets ends up with a positive net present value in the base case scenario, while 7 of them ends up as a negative investment. If you turn into the Rystad 1.5 scenario, 113 of these assets ends up with a positive NPV, while 54 end up with a negative one. And if you see this per country, the cash flow from the investments are quite, or the net present value divided per country is positive in most cases, except in the Rystad 1.5 scenario for a couple of countries. If you then look at the discoveries, remember this involves all discoveries. So when 184 of them are positive, have a positive net present value in the Rystad base case scenario, while 44 of them have a negative net present value. But then again, Equinor has a higher expectation to the oil price than Rystad. So maybe Equinor would still make an investment decisions on some of these assets, even though they are not deemed profitable by Rystad. So that is why I have included them. If you move into the IEA net zero emission scenario, almost half of the projects end up with a negative return on investment. And then this is splitting it by country. As you can see, in the base case, a few of the investments abroad are negative even in the base case scenario. More of them turn red in the IEA scenario, and most of them, except Norway, turns red in the Rystad 1.5 scenario. And this is not because it's particularly cheap to extract oil and gas in Norway. It's because Norwegian politicians decided to implement an oil tax, a temporary oil tax regime when the oil price dropped in 2020, which is super beneficial to oil and gas companies, having the Norwegian state take 90% of the investment costs and the risk. So even though Equinor ends up with a positive cash flow in these cases, the Norwegian state might end up losing money because these investments aren't profitable before tax. So that is the reason behind Norway's numbers. If you then look at the undiscovered resources, very few of them end up positive. A majority is negative in the base case, but then again, these are undiscovered resources, so they are associated with a lot of uncertainty. This is based on a best guess coming from Rystad, where they have probability weighted the resources depending on how likely they think they are to be extracted. So giving this per country, you could see that it's almost red in all cases. And it doesn't come as a great surprise when you know what we know, that the world has already discovered way more oil and gas than we can actually consume, that these looking for more oil and gas wouldn't end up profitable in a 1.5-degree scenario, and in many cases not in the base case scenario either. So this is the reason behind our shareholder proposal, where we want Equinor to cut their implement a climate target where they have a 50% reduction of absolute emissions, which also includes scope 3, and that this means an actual downscaling of their fossil fuel activities. And we want them to report on this in a transparent way every year in its energy transition plan. So that was everything I was planning to present. I'll see if I have time for a few questions. Otherwise, I can follow up on email with you as well. Okay, so we had one question about NPV. I have added this as a footnote, but we have used a 10% discount rate nominal when it comes to as a required rate of return. And this includes a 2.5% inflation rates. In many cases, investors would probably have a even higher required rate of return than 10%. But this is what Rystad recommends as their base case assumptions. So we have used that one. Yes. Okay. No more questions? Okay. Well, we will share our my email if you have anything you want to follow back on, and then we can answer any questions you might come up with in the end as well. So thank you for joining. Ragnhild, do you want to add anything? Or?
Yeah, thank you so much, Guro, and thank you for listening in for this half hour. And we will be present at the AGM in Equinor next week to present the proposal, and hopefully we'll get some support for that proposal. So if you know investors that have assets in Equinor, please share this information for them, because I think that would be valuable for them. So please have a nice day, and let us know if you have any further questions. Just send us an email or something.
Thank you.
Okay, goodbye.
Bye.